Okay, welcome everybody. Welcome back to lesson number 18, trade expectation. This is going to be an audio because there's really more of a mindset part of your trading as opposed to something that's actually technical that we could put on charts and that kind of thing. And a little bit is putting the pieces together, but more importantly, it is geared towards the thought process that you have while you are developing your trading scenarios and choosing prior to getting into the trade how you will manage the trade. I think far too many people put a trade on and then basically determine how they're going to manage the trade after it's on. And I think that to some degree that's not the worst thing to have that thought process. However, if you want to be really good, you don't want your ideas or your processes to be the worst thing or not the worst thing. You want them to be the best. You want them to be the most thought out. You want them to be repeatable. So what this lesson is going to be about, and this is what I want you to write down, it's called trade expectation. Trade expectation. Now, exactly what does that mean? It doesn't just mean do you expect to make money on a trade. All right, so I'm going to ask you to write down a couple of definitions here. Now, the beauty of it being on audio, you can pause it and listen to it at any time and write the notes down, which is what I do all the time. I'll be listening to a seminar or something like that, and I'll pause it, write notes, pause it, write notes, and sometimes you have to go through it 2 or 3 times to get all the notes perfectly. And there's a reason we don't have this one in a PowerPoint. I really want you to be writing this out so that you learn and actually think about what you're writing down. Because sometimes when you see it in a PowerPoint, you see it on a video, you see it on a slide, it doesn't really sink in as much. And when you write it down, you learn it twice. So let's get into the actual definition here. We're going to call this the trade expectation effect. Everything has a cause and effect. This is the trade expectation effect. Now, let's put a definition on what trade expectation is. First and foremost, it's the probability of your profit target being reached. Now, think about that. Most traders go into a trade and they determine what their stop loss is, and then as it moves in their favor, one of the biggest problems they have is when do I get out in my favor? So we're going to take that a little bit further. We're going to first assume you've established a profit target. Now the next part of that is I have a bull flag in stock A, I have a bull flag in stock B. Do all setups like that have the same probability for follow-through? The answer is flat out no. As I've discussed quite often during the program, you want to learn to build an argument for your idea. And the way to build an argument for your idea is to see how many different pieces you can put into the equation. So the probability of your profit target being reached means being able to make the distinctions to build a better argument than just the fact that you have a flag or a pattern. Then the sequence has to be put in the right order. And the way I generally explain it to people is pick a side, then pick a spot. That's the first section. Most people pick a spot. They pick the pattern. They pick the flag, the breakout, the consolidate, whatever it happens to be. Pick the side first. The side first is the argument. The side first is the direction. So the probability of your profit target being reached can be increased by adding to the argument. If you only have the tactic, it's not enough. It's not enough to feel conviction on all of your ideas. And I discuss this a lot of times with the people in the Active Trader Mentoring Program, that you must have more than one reason for the trade. So the second part of this definition is the probability of the trade moving in the direction of your scenario. Are you just leaning on the stock itself? Are you paying attention to whether it's a markup, a markdown, accumulation, distribution? What is the stock doing in its average volume compared to what it's doing right now? How busy is the tape? We've already had a tape reading lesson. Is it trading consistently, actively in the direction of your idea? Is the sector obvious? We actually had a scenario that we developed yesterday in a particular sector, and it actually was the casinos. And the scenario was in LVS, and we developed one scenario for if it went in one particular direction, which was a much higher probability trade, and then we developed another scenario where if the stock holds this particular level and the other stocks in the sector do the same thing, then this is a different trade, but that trade would be a B trade compared to the other scenario, which was an A trade. So you have to learn to break down your trades into your best ideas, and you always first want to go to your A ideas. As we talk about quite often, for an expectation to allocate money to the market, you always want to have your A trades your first choice, because you always want to exit a trade clearly saying to yourself, when I allocate money and if it doesn't make money, it was a good idea, as opposed to I allocated money to a crappy idea, I just hoped it worked and it didn't, and you'd be surprised how much of that really burns a hole in your pocket. The third part of trade expectation is risk adjustment. All scenarios don't offer the same probability, so all scenarios should not have the same risk. And again, think about it from a perspective where, let's say you're a real estate investor and you're in a really good neighborhood, and you found this unbelievable deal where the husband and wife are fighting, and they have $200,000 in equity in the house, and they just want to dump the property, but you have to buy it for mostly cash, and you happen to have the cash, but you have to do it all for cash. So you're making an all-cash investment in a really, really good deal. It's a little bit more risk because you're putting all that cash on the line. Your stop loss in this case is a pretty big one. You have a lot out there, right? That's a pretty good offer. It's a pretty good opportunity. The risk adjustment there is going to be based on the probability and how solidly you built that argument. Now let's take another scenario. Same house. They're not really fighting. They don't necessarily need to move. They don't have a lot of equity in the house, and they want to try and get what they want to offer for it. It might be a good deal because it's the best house. It's not the best house in the neighborhood, but it's a fantastic neighborhood, so maybe there's some upside. How much of your personal allocation are you going to make to that idea? It's significantly different. You're not going to go full bore in because there isn't a margin of safety, for lack of a better investment way of putting it, in the idea. So risk adjustment should also affect how you manage the trade prior to the trade based on the trade expectation for follow-through. In other words, let's go back to the top. The probability of your profit target being reached. So your profit target on good ideas is actually built in based on how solid the idea is. So the better the idea, the more you can put into the idea. Next we have share size. Share size will be affected by trade expectation. Trade expectation will affect your commitment to the idea. The better the expectation, the more share size you should have per idea. Period. And I'm going to explain this to you in a way that most traders might not get it. And it's very simple. I had somebody yesterday tell me that you can't go broke booking profits. Now, as a general rule, I don't disagree with that. So I'm not going to say that's not. It's a cliche for a reason. However, you don't want to just be mediocre. When you attack the market to learn how to become a professional, you want to strive to be the best that you could possibly be within your resources. And your resources are your time, your money, your education, your experience up to this point. So I want to take this a little step further. In regards to the thought process that you can't go broke losing money, I want to get you to the point where you must learn to make a distinction when more is available. You must learn to make a distinction when everything that goes into your argument is present right now. When that occurs, your trade expectation, your risk adjustment, your share size, the number of positions you have, your expected hold time for that idea and bunch of ideas must increase. It absolutely must increase. You must understand when there's more people in your store and your register is going to ring and ring in a big way. You must earn more when more is available. Must. So what actually goes into developing your trade expectation? Well, traders need great leadership for a great trading environment. One way you can trade with conviction. That's what we would envision as a great trading environment. Obviously, you want the environment to be following through. You want to be in this is from a trade management perspective, from being in the trade. I'm going to explain how you're going to feel this. You put the trade on, and you're not nervous about being in the position as soon as you put it on because the market's so strong or the market's so weak, and you're on the right side of what's obvious in the market. And I'm going to just take you back a little bit to when I first started trading, let's say 99, 2000, and let's think about it. Everybody knows the stories about how everybody made money during the internet boom, blah, 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 right? Well, why did people make money then? Why? They were boom trades. We're going to nickname them boom trades. You got long because they had every reason to believe, you had conviction that this trading environment, your expectation, your trade expectation was the market was going up no matter what. It was just the environment that they were in. People traded with a conviction and an expectation that you want to be a buyer because we're going up. At some point today, this afternoon, tomorrow, we're going up, and the market corrected a lot of mistakes. Now, I'm not saying you're going to get that today, but what I am saying is that is available sometimes, even during this market. You just have to be good enough to understand when those boom trades are available for you. So what I want you to do now is I want you to visualize a pyramid, and we're going to build a solid trade expectation for you to take into your head and into the market, so that as the market's unfolding each day, you will have a solid idea of how to build a foundation for an increased trade expectation. So on the bottom of the pyramid, we have obvious institutional order flow. You could look at any chart, and on a broad-based, across the market perspective, broad-based market, buyers or sellers are clearly in charge. So you start with the broad market itself. That's the base of the pyramid. And think about the perspective of this. If the broad market and many different broad market indicators, obviously they're broken down, are in the same direction, they're in sync, that means just from a layman's perspective, a lot of money is being put to work in the same direction with the same idea. So broad-based market is the first part of developing a trade expectation. The next is institutional order flow, obvious across many different specific sectors, or just a particular sector that you trade. Like I just mentioned a trade in the casino stocks, but are all of the semiconductors doing the same thing? Are all of the oil services stocks doing the same thing? If you have broad-based, it's one thing. If you have broad-based in sync with a specific or group of sectors, that builds to the argument. And your trade expectation where money is flowing, always think about it from the big picture. Institutions, hedge funds, whatever the heck you want to call them, if money's flowing in the same direction, your job is to hitch a ride, and it's just a matter of determining how obvious that ride is. So we have broad-based obvious, sector-specific obvious, market internal obvious, and then you work up all the way up to the top. Stock specific, buyers or sellers are doing something obvious. Now, here's the point that I want to make. If broad-based, sector-specific, and stock-specific are all doing the same thing, you must increase your trade expectation, fully expecting your profit target to be reached, which means you increase your positions, increase your risk allocation, and probably increase your share size. Now, again, that's relative for everybody. Increasing your positions could be just going from one position to two. Don't go crazy with 5, all right, unless you can handle it. So broad-based, sector-specific, stock-specific. Work your way up. How many of those pieces at any one time are all in sync where you're hopping a ride on a ridiculously obvious boom trade? They don't happen all the time, but you have to understand when they're there. You have to understand when to adjust your trade expectation up and down. Let's just take the top of the pyramid. Let's say only one specific stock in your list is obvious. Buyers or sellers are clearly doing something in that stock, clearly in charge, but the sector's not clean and the market is a mess. It's going positive, negative, positive, negative. You don't have the bottom 2/3 of the pyramid. You don't have the broad base, you don't have the sector specific, you just have that stock. So your trade expectation is going to be a little bit lower. So maybe you lower your share size a little bit, maybe you tighten your share size, and specifically, actually to advance a little bit here, a trade-specific management part of this trade is if you have the bottom 2/3 of the pyramid in sync with your stock, you can probably have a little bit wider stop loss, fully expecting that your profit target will be reached, because it's okay to risk a little more because the upside potential is there. If you're only stock specific, you're probably going to have to manage the trade with a reasonable stop loss, a good amount of shares for the proper risk. Most likely, if you get stopped out, you will have to re-enter the trade because it's not as obvious in the higher time frames. So we have broad-based, sector, stock-specific. Broad-based, sector-specific, the bottom two parts of the pyramid. Top of the trade expectation pyramid is the stock-specific. Next time you're looking at a trade, ask yourself, how many pieces of those puzzles do you have? There's 3 pieces. Bottom broad-based, stock-specific, sector-specific, and then stock-specific. If it's only stock-specific, your expectation has to go a little bit lower. So work on the skill of developing a trade expectation for your ideas outside of just the pattern that you're looking at.